You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Albert Liu, Managing Director of WB Wealth Management and host of the Power and Market Report. Welcome to the show, Albert.
Thanks, Jim. It's great to be here.
An oil recession. This time around, it's not the stock market that's crashed on us. It's the price of oil, and you believe it's going to lead North America down another dark, dangerous, dank path that everybody said we had just got out from the last time.
Yeah, exactly. I mean, the stock market could be next, but I think if you look at this situation, it's going to be very difficult, at least for specific regions within the U.S., to avoid what looks like a recession, especially, you have North Dakota, Texas, where I'm from, or where I live, and Alaska. These states rely pretty heavily on oil for tax revenue and jobs and those sorts of things. So I think it's going to be very difficult. And the price down in the mid to low 40s. Some people think it's going to go even lower, in which case the pain will just get worse.
The average consumer is going to save about $1,500 if these low prices continue. But that doesn't replace a job that paid you $80,000 to $120,000 a year in the oil patch, does it?
Exactly, and that's why this is going to be very regional. I suspect if you live in a place where the economy is not dependent on oil for jobs, then this is going to be great, right? We have in Texas, gas is around $1.70 a gallon. Even in California, it's below $3, which is good for them. But if your job is tied up in it, and where so I'm in the Woodlands, which is just north of Houston. And if you look on the highway, or if you're on the highway that is right near my office, you can see Exxon building what looks like a town, basically, just south of my office. And it's reflected in the businesses, it's reflected in the number of people moving here, and the home prices. It's just, if you believe in what they call the skyscraper indicator, that is the correlation between the aggressive building of skyscrapers and the recessions that follow, then this is a bad sign, especially for Houston. But you're going to see this same thing in other states. And I read an article. I think the people in Alaska are very concerned because they derive the majority of their tax revenue from oil extraction. So if you think about this, and North Dakota is in a similar situation, although not quite as bad. But this is very bad for people who are not even employed in energy, because when those people, when the government starts to lose revenue, and they're faced with the choice to either reduce spending or go out and find that revenue somewhere else, you know what they're going to do, at least their first move. I mean, we spoke last week about China's big tax grab. Well, that statute's been on the books for a long time, decades. Why are they looking at it now? It's because they need the money. And so if you're in one of these places, I saw another story actually that, Kern County in California? This is somewhere in the middle of the state, if you're not familiar with it, but there are a lot of oil rigs out there. And California, I mean, they are a producer of oil, but as far as their budget is concerned, it's minimal. But even still, at the local level, certain communities are really dependent on this oil revenue, or the taxation. Let's call it extortion proceeds. I think they call it a severance tax. That's the euphemism. But whatever you want to call it, it's dwindling. And so they've got things that they got to pay for, and the pension is an issue. And then this article is funny because it mentions they're just building a new jail, so they need money for that. Typical. But they're going to go out and they're going to try and find that revenue somewhere else. The last time we had a recession, I remember specifically every little town between Houston and Dallas, they had their highway patrol guys out trying to generate some revenue. And so even if you're not in the oil patch, I mean, this is obviously not good.
And of course, when governments are desperate for money as well, I've heard talk in Alberta now that because they're losing oil royalty money, that they may bring in a provincial sales tax, something they have never had before.
Yeah, they love to seize the opportunity, don't they? Yeah.
I mean, up until this massive loss in the revenue from oil, they had a real shortage of labor, and they were willing to pay you almost anything to go work in the oil industry. And I'm wondering, when things do pick up, are they going to have another scramble to find personnel because people will have found other jobs?
Well, that's the problem with the government meddling in interest rates and, with their QE stimulus is they're constantly disrupting these markets that are trying to settle at the optimal distribution. So what's happened in Calgary is a great example of that. You have people, and this is a clear indication that there's something wrong because I spent time in Vancouver. When you hear people saying that, I'm leaving my job in Vancouver to make several times as much in Calgary doing the same thing, or, in the States during the real estate bubble, it was a guy delivering pizzas. One month could be a mortgage broker the next month making, 10,000 or more a month. So when you see that stuff happening, that's basically just the business cycle. That is the government or the Federal Reserve or the Bank of Canada going in and disrupting markets and causing these enormous distortions that result in labor shortages, which is what you described, and then labor surpluses, which is what they have now. Following the oil market, they're scrambling to take these rigs offline. One estimate I read says that they think they're going to, by the time this is over, we might have 60% of the active rigs being idled. And that's similar to what we had in the 2008 crisis. So we're talking about almost 1,000 rigs. And if you think about the jobs that go along with each of those rigs being taken offline, it's a serious issue. I think those people from Calgary are going to be going a lot of places. You see the home index has just turned around. So you see that in Calgary real estate. But the performance in real estate has just been crazy over the last several years. I think it's up maybe 25%. And Toronto, actually, now that you mentioned Toronto, has been up too. And so that's also a bubble in the making. And the concern is that this popping of the energy bubble is just the beginning, because if you look at it on the surface, you might think it's not that bad, meaning if you just look at the amount of capital involved and the number of jobs at stake, you would conclude that perhaps this is not as bad as the real estate bubble. But if you take into the fact that we never really fully recovered from that real estate bubble, meaning we really never liquidated all of the mistakes. That's why you have the Fed continuing to stimulate until recently, and other central banks doing the same thing. I think a gentleman at Citibank, a researcher, estimates that it takes about $200 billion a quarter of monetary injection to just keep the stock and bond markets from collapsing. And so we're still heavily deep into that bubble that we never fully liquidated. So now this energy crisis, that just goes on top of it. And then all of the additional real estate that has been put on the market, like, for instance, in Houston, it seems like they just never stopped building, actually. It's just continued. The party has gone on. So if you look at it from that point of view, the point of view that all we've done is add on to the malinvestment and compound it, this could be really bad by the time it's over.
And there's also oil derivatives. All these banks have made massive loans to oil drilling companies, with the idea being with $120 oil, maybe $150 a barrel oil, that these loans would easily be paid back. But at $40 a barrel, obviously there's going to be a lot of loans that default, and then the derivatives from those. So banks will start to teeter, and both Canada and the U.S. have passed legislation that allow the banks to dip into your bank account to balance their books.
Doesn't the logics seem a lot like what we heard during the real estate boom, and that is derivatives, CDOs, basically debt issued on homes, and what happened when the homes lost value? The same thing is happening here. So yeah, that's not good. That's not good. And like I said, the people that know these things are saying that we could be stuck with these low oil prices for a very long time. And I heard Rick Rule once say in an interview that you just can't take a $90 pro forma and walk into a $40 or $50 world. The math just doesn't add up. And so that's what we're seeing here. It's going to be bad.
We'll have more with Albert Liu right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Albert Liu, Managing Director of WB Wealth Management and host of the Power and Market Report. Albert, if we do go into an oil-driven recession and all the signs are looking that way, what's going to be the overall impact on our lifestyle?
Well, as we were talking before the break, Jim, some people are going to benefit from the lower energy costs. And that, in general, lower costs are a good thing. It makes a lot of businesses more profitable, gives you more money in your budget. But this is not happening in a vacuum. So the problem is we're just going to add to the ranks of the unemployed. And sure, if you look at the numbers, the headline numbers, you're going to think that unemployment is not that bad. I think they're reporting below 6% now. But if you look at the alternate statistics, ones that include the long-term unemployed, which is the way that we used to measure it actually in the U.S. and the way I believe you still measure it in Canada, we're up above 20%. So unemployment is still a problem. And so we're just going to add to that problem. Not only that, you alluded to a possible financial crisis because of all of the debt that might have to be written off. So this is obviously kind of a gloomy outlook. And it's difficult to say which way it's going to go because the markets are going to be the markets and the Fed is going to be the Fed. And what I mean by that is the market is going to want to liquidate all of the debt. The market is going to be, there's going to be a deflationary force coming from the market. And what the Fed and other central banks will decide to do is whether they want to spend what's left of their credibility and balance sheets on reinflating this bubble. And that's something that I can't tell you. That's something that really nobody knows. Well, I thought it was kind of humorous, actually. For the last week, we've been hearing about Deflation Gate. Here we are a couple of days before the Super Bowl. And all anyone wants to talk about is deflating footballs, where the real deflation is going all around us. And it's asset price deflation is what people have to worry about, and all of the jobs that are going to be lost. This is really, the result and the consequence of these business cycles that the government has started. And what people don't understand, I think your average Joe who's watching the economy doesn't understand, is that, regular bankruptcies are normal. Businesses are always going to fail here and there. And to draw on the football analogy, it's like a halftime adjustment. You take certain players out, you put different players in. That's the way the economy works, and that's totally normal. But what happens when the government starts tinkering in situations like the Calgary and Texas economies that benefited from the oil boom? It just creates these massive dislocations. So what we have coming up, I think, is the mother of all halftime adjustments. It's going to be pretty ugly. So I recommend everyone hold on for that. And I really feel sorry for the people who are going to be caught up in this, particularly people who are going to lose jobs. That's really a pity. I guess what I'm saying is that maybe we should have the winning coach of the Super Bowl be the Fed chairman, because I think both of those guys would do a better job than the people we have. Certainly, Bill Belichick already talks like a Fed chairman, and I think he's quite a bit smarter than what we have. The average man understands now that in their logic, what goes up is going to come down, and they see that this oil bubble has been blown up artificially, and they see it going away. But it's even worse than that. It's not just flushing resources down the toilet. It's the problem compounding and getting worse and worse. And so that's what we have. We have one bubble being compounded by yet another one, and the problem just getting bigger and bigger. And so at some point, you're going to have a pretty serious day of reckoning. And unfortunately, that day is getting closer and closer.
And I've heard actually the downturn in the oil patch is a natural cycle, and it's probably one of the few natural cycles where the government has very little power to try to influence it.
Well, they don't control everything. That's true. But they certainly, by the amount of fiat money they're putting in circulation, and they're tampering with interest rates, they certainly have a big hand in it. And they can't control the ultimate outcome. But I think most people would agree that without all of this QE injection, you wouldn't have had all of the capital pushed into the oil sector, and then all of the pain that comes with the unwinding. So you're right, they don't control it all, and people will do what they will, but they do respond to these incentives, just like they did in the housing crisis. And so there's been a pretty strong incentive to go out and do all this exploration and invest all this capital, and unfortunately, it looks like it was all malinvestment.
Well, Albert, thanks a lot for chatting with us.
Oh, it's my pleasure, Jim. Thank you very much.
My guest has been Albert Liu, Managing Director of WB Wealth Management and host of the Power and Market Report. And if you check out his website, albertklou.com. You can find links to Albert's podcasts and commentaries. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.